saw retail sales post a massive miss. It missed big time. I know some tried to blame the weather, the fires in Los Angeles. It's always weird when they do that because you got to wonder, the folks who contributed to the consensus estimates, were they unaware of that stuff? The real tragedy, though, really is that we are getting so much less and paying so much more in general. I want to bring in marketgauge, their managing director, Michelle Snyder. Michelle, so inflation last week higher than anticipated, retail sales lower than anticipated. Is this sort of an anomaly, or could it be a sign of things to come?
Well, first of all, great to see you, Charles. Well, let's look at it sort of the glass half full, half empty. So if we go with the half full, we can say online shopping is still robust, right? Shopify did really well. Consumers are spending a lot more money on health and beauty and travel, so the spending habits have shifted more towards the vanity. The technicals, definitely, if we look at some of the stocks, particularly the XRT ETF, which is nice, staples and discretionary, holding major support. In spite of all the fears of inflation and tariffs, those are holding up well, that whole sector. And basically, we're climbing the wall of worry. So that's a good thing. This week we have Etsy and Walmart. That'll be interesting. The half empty is, well, yeah, GDP is a concern because it's 70% in terms of the consumer. There is more fear. We're worrying about jobs that could be lost. Higher food prices are certainly haunting us. And people don't really know what's going to happen with tariffs. So until we see the technicals turn negative, I'm all about price dictating the narrative. And right now, Bryce is saying, okay, could be better, could be worse, but we're okay for now.
Hey, let's talk about your watch list because it's somewhat eclectic. I don't know, Adobe, Match, Moderna, and Symbiotic. Let's say SYM because this is a relatively new name to a lot of folks, but it's got a big following on Wall Street.
Well, first of all, it was one of my top picks in 2024, and that didn't work out too good. Luckily, the technicals really helped time your way in. It went down 37%. But essentially, robotics is the hot topic right now. People keep looking at what's the big growth. And Symbolics is a warehousing system that basically speeds up the efficiency of fulfillment and also in terms of inventory, supply chain efficiency. The earnings that just came out were really bad. It's a very volatile stock. And it takes 24 months to install a Symbolic system, and it's expensive. Walmart is the biggest user of it. But in the future, as things get better and they work on some of this timing in terms of installation and expense, it could really be the way to go because just seconds saved in fulfillment or in supply chain can really save a company a lot of money. Technically, $23 has been sort of the low recently. I like that. Over 28, I might nibble. Over 33, even more. But you have to have risk parameters in this volatile one.
I love the fact that you know what these companies do and you actually can articulate the value proposition, not just from the next few weeks, but over a period of time. I got 30 seconds. A lot of folks on the gold bandwagon. I think you're spying silver, though.
Well, yeah, and silver right now, the ratio to gold to silver has been around 90, which means gold is 90 times higher than silver is price. Back in the peak in the 1979-80, it was only 17. So we know there's a lot of room. The dollar obviously is an impact. Supply chain issue for silver. If silver starts to pick up here, gets through $33, $35 an ounce, even if gold stagnates, that still could be very bullish for silver. And right now it's trading just like gold was. It finds a level of support, it rallies, it sells off, it holds a support, and then it does the whole thing again. So we're very bullish.
Looks like it's on the verge of another major breakout. Michelle, thanks a lot. Really appreciate you.
Thank you so much.
All right, folks, everyone's talking.